It's now time to get some corporate conversations. Let's welcome Ramesh Nair, MD and CEO of Mindspace REIT, reported strong set of numbers and the vacancy levels reduced, leading to higher occupancies in the quarter gone by. There were some acquisitions that the company announced as well. So let's try and understand what the outlook is going forward. Ramesh, good afternoon. Thank you so much for joining in. FY26 has ended on a strong note. Give us a sense of what FY27 will look like when it comes to distribution, your NOI, and the kind of acquisitions you're looking at.
I'll start a little bit by giving color of what just happened in the previous year, Sonal. So record operating performance, highest ever occupancy, very strong leasing spreads. Demand again driven by GCC and domestic corporations, which is obviously translated into rental growth and cash flow visibility for us. Portfolio is expanded through the two acquisitions which we reported recently. Cap rate, we've seen both cap rate compression and rental re-rating happening. We typically don't give guidance, but from a NOI perspective, from a revenue perspective, from a distribution perspective, FY27 definitely looks good. Our Navi Mumbai vacancy levels have dropped 2 years back. Airoli West, which is the second biggest park, used to be 72% occupied. Today, that's 99% occupied. Madhapur, today again, our largest park is 99% occupied. 7 out of our 14 parks, again, are 100% occupied. We are looking at how we can bring in more data centers into our portfolio. We're looking at how we could do more redevelopment into our portfolio. Our 3 under construction projects in Hyderabad. One is a 1.5 million square feet fully pre-leased. The other is 600,000 square feet, again, fully pre-leased. And the third one, 1.7 million square feet, 1.5 out of that 1.7 million square feet is again pre-leased. So we're looking at a good year.
Okay, Ramesh, get that totally. Well, you also understand you're in the process in talks to acquire 2 large assets, International Tech Park, which is in Chennai, as well as Commerce Zone. So what is the kind of capex outlay you have for those 2 acquisitions? What does that do to the balance sheet, and how will you fund these acquisitions?
Vivek, these assets would be funded through debt. Both these assets put together would be 5,500 crores, 5.2 million square feet. We studied which is the best market for acquisitions in the country today. And we realized that Chennai has the lowest vacancy at 7%. Institutional supply in Chennai over the next 2 years is extremely limited. And when we looked at the absorption trends in Chennai, we realized that pre-COVID, Chennai used to be a 3 million square feet net absorption market, and it's become a 6 million square feet market now. And when we got the opportunity with both the sellers, in these cases are institutional owners, both these assets have mark-to-market opportunities. Both these assets are premium, high-end, low-carbon trophy assets. We also, between these assets, we have opportunities for core, it's fully leased, core plus where there's some amount of vacant space, and value add where there is under construction. So all the tick marks on all these assets. That's why we decided to go after both these assets.
So how does this change the face of your P&L? When does it start adding to your NOI revenues as well? And when you say Chennai has been a strong market, 3 million square feet to 6 million square feet in terms of absorption, a lot of competition also is what you would be seeing there. Your peers or your competitors are also looking at this market. How do rentals work in that case?
On a stabilized basis, Sonal, both these assets would have between 220 to 240 crores each of NOI to our already existing 2,600 crores of NOI. We studied competition extremely deeply before buying these 2 assets. There's 2 institutional quality supply coming in and around this market. Both these are coming exactly after 2 to 3 years. So we have a clear 2-year space here to lease the vacant spaces in these assets.
Ramesh, a quick question from my end. Number 1, West Asia war, has it had an impact on the kind of conversations that you're having with clients? Secondly, how are you viewing interest rates given the fact that a large portion of interest outgo is something that depends on that? So going into FY27, how is it that you're viewing both of these factors?
So Vivek, oil price surges will obviously impact inflation. Our construction costs, I was looking at what is the construction cost in Jan and what's the construction cost today. that's gone up around 6.5% from 4,650 to 4,950. But again, all this is not spent if RMC and cement has gone up 8%, but we are not buying all the RMC and cement now. It's going to be spread over 3 years in a building. So obviously, it's spread out. In a few cases, we have seen travel restrictions and airspace disruptions impacting transaction timelines. This is what I've heard in the market. It's not impacted us. We're also hearing in the market that some clients are a little cautious about capex deployment. And also, there are cases where I've heard of clients slowing down decisions. In spite of all this, we had a record quarter, record March. I also feel there are some positives for India from this. Firstly, the data center opportunity. I feel there'll be a lot of data center demand from Middle East, which will move to India. And obviously, rupee depreciation makes India attractive for GCCs, and rent in dollar terms still remains the same. And whenever these kind of trends have been noticed, whether it's the Ukraine war in 2022 or now, there would always be some amount of pent-up demand. And we are well set to take advantage of that pent-up demand.
That's good to know, Ramesh. The industry going through a lot of tailwinds, and GCC boom is one of the triggers for the growth that we are seeing. Always a pleasure speaking with you. Thank you so much for decoding Q4 numbers and the outlook going forward. We'll do one thing, slip into a short break.